Welcome to your final financial stop, where today we're going to be looking at banks and how they work and how you can take advantage of the systems they've put in place to earn yourself time and money. Before we get started, I want to say please subscribe, share this video if you liked or learned anything within the course. Follow my Twitter and stay up to date with what I'm doing and how I'm trading, and please be safe while taking a risk in any investment. So how do banks work? Banks manage the flow of money between people and businesses. They offer a safe space for these entities to store their money, and then banks use that money to make loans to other people. Banks earn interest with these loans, as well as collecting fees from you, as well as making their own money from their own series of investments. Banks are overseen by the Federal Reserve System, and they help regulate and ensure money supply, inflation rates, unemployment, and much more. The Federal Deposit Insurance Corporation insures deposits for up to $250,000 from a bank's failure. So if your money were to be lost or stolen, and in some cases your personal data, you might be insured. The history of banks dates back to 2000 BC in India, as well as the Roman Empire, where they first started utilizing the service of lending. From that moment going forward, our world changed, sometimes for the better, sometimes for the worse. The Great Depression in the 1920s, every $9 lent to an individual, $1 was used for collateral. The market fell and banks failed to collect their debts because they didn't require these lenders to prove they could pay for their loans. Citizens rushed to the banks to pull their funds, causing bank runs and causing billions of dollars to be lost, dropping wages and unemployment by almost 50%. The Glass-Steagall Act helped investment banks and commercial banks to remain separate, so risk wasn't as involved in the everyday normal life. In 2008, lending targeted low-income homebuyers. Financial institutions started taking on more risk due to trading commodities, and the burst of the housing bubble did not help things. It took a $700 billion bank bailout provided by the government in order to get us somewhat on track. There are many types of banks, and central banks manage the supply for a country, such as the Federal Reserve System. They set monetary policy as well as interest rates to help control inflation. Retail banks offer loans, deposit accounts, and other services. This also includes online banking. Commercial banks cater to businesses just as well as individuals, however, offer greater benefits to larger entities. Investment banks typically have to deal with securities trading and managing investor accounts, such as brokerages. Shadow banks generally are unregulated and focus on investments like insurance companies and hedge funds. There are savings and loan associations that help people borrow money to buy and refinance a property. And credit unions, otherwise known as cooperative banks, offer the same services, however higher dividends, but require a membership criteria of a minimum balance or more. Common bank fees include monthly maintenance, especially if it's a brick and mortar establishment, excess withdrawal fees, early withdrawal penalties for certificate of deposit accounts, overdraft fees, ATM withdrawal fees unless it's in the network, debit card replacement fees, and cashier's checks and money order fees. I mean, after all, banks are businesses. Banks are considered lenders and will act in their best interest to protect their interest. Lenders repay money and owe a percentage of that if they fail to pay it all in time. Not only do banks make money with fees and interest, when you deposit your money into a savings account, banks take that money and invest it into a vehicle that brings them 11%. Meanwhile, it's bringing you less than 1%. Their investments are liquid and can be withdrawn at any time, therefore still being able to lend to you. Life insurance is the greatest asset of banks today. So let's talk about savings accounts. Savings accounts allow you to earn 0.06% on your deposited money. That's 60 cents per $1,000 invested. The only upside is that it's great for building an emergency fund because you have limited access to it. You won't be tempted to withdraw money from it. Checkings accounts don't typically offer interest on your deposits, but offer separate benefits such as ease of access. So a savings account can be good for avoiding debt or maintaining liquidity, but it isn't the best way to earn. So keep in mind it may be important to have more than one account. Consider opening separate accounts to take advantage of some of the benefits of some other banks. Online banks offer high interest but no ATMs available, so a physical bank is a good secondary option for that issue. It's harder to keep track of spending with multiple banks, however you can divide those banks into separate purchases such as gas, grocery, and entertainment. There's an increased risk of fees, especially if you have more than one bank, as well as increased risk of fraud if you have more than one card. So deals you don't want to miss out on are debit rewards and the occasional sign-on bonuses. Sometimes they offer better rewards than a credit card company is able to offer you based on credit score or other factors. Banks should offer you your credit score for free at least once a year. Explore some different investment vehicles. Make sure you sign up for direct deposit and mobile online banking to keep tracking your money easy. There are some alternatives to checking accounts, such as credit unions, which typically require a minimum balance, but offer higher interest rates on your deposited money. Neobanks offers less services because they're not typically brick and mortar, so loans and facilities are constricted, but they are able to hold crypto and is worldwide, so an instantaneous payment is possible. Certificates of deposits earn interest greater than savings accounts. The longer the term, the higher the APY, but beware of inflation as that could negate it. Peer-to-peer lending allows you to earn a greater interest because you loan the money and you make the interest, but beware because your money is not FDIC insured, which means the borrower could default. Another alternative is a brokerage. Whether you invest in stocks, mutual funds, real estate, or other types of investments, you can play a factor of risk and reward in the markets and earn money that way, as well as use prepaid cards to avoid banks. Shopping through Amazon or Walmart, you can find these that are reloadable, yet they have high fees, so be careful. Some of the pros and cons we'll see of banks is banks have options of accounts, trust funds, Roth IRAs, and many, many more. They're relatively safe considering they're FDIC insured. Most banks are nationwide and ATMs can be found essentially anywhere. And lastly, they're moving online to cater to more convenient needs. Banks offer low interest rates and interest could equate to none if pulled early or our country enters a state of hyperinflation. There are tons of fees associated with banks, so always be on the lookout for that and test out banks before you officially sign up for a checking account. Don't assume you're being given the best rate. It's easy to assume that banks care about you and they give you the best price automatically. It's harder to get a new customer than to keep a customer. So they're going to do their best to make sure you stay with them. So pay attention to how long your rates will last, whether your interest rate only remains at 3% for a year or if it goes on beyond that. It all comes down to communication. Communicate your closed accounts so you're not penalized for leaving it dormant. Utilize certificates of deposits and their 1.8% potential. And lastly, let your bank know when you're traveling to avoid cancellations. It's never a good look when your card gets declined at a restaurant and you know you have money. And thank you for joining me today. Subscribe to my Patreon for more information on how you can potentially save or earn lots of time and money. Follow my Twitter and ask me any questions. I'd be happy to reply. Don't forget to share and subscribe if you liked or learned anything from the video. Thank you for joining. Quick disclaimer to remind you this is not financial advice. Any information found here should not be substituted for information found from a professional financial advisor. Understand that every investment has its own risk and reward, so please do your own research. This is information based on my own findings, and I am not responsible for what I do and do not share.